This episode is brought to you by HubSpot. Now, did you know most businesses only use 20% of their data? That's like playing a football match with 1/5 of the team. It's going to be hard to win, right? Unless you have HubSpot. Their customer platform gives you access to untapped insights in emails, call logs, meeting transcripts, and all the other data you need to grow your business. Because when you know more, you grow more. Visit HubSpot.com today.
Hello and welcome to The Rest is Money with me, Robert Peston. Steph will be back in a couple of days, but I'm delighted to be joined by one of our absolute favourite guests. That's Mohamed El-Erian, who is the professor at the Wharton Business School at the University of Pennsylvania. Mohamed, so good to see you. I think you're in the US at the moment, aren't you?
I am, Robert, and thank you for having me.
It's always a pleasure. We have just witnessed a summit or a meeting between President Trump and President Xi, which President Trump declared was a 12 out of 10 meeting in terms of, for him, its success and importance. How would you rate it?
So I think that both sides escalated tension in order to de-escalate. We got the de-escalation. However, it is a truce. This is not a peace accord. This is simply a truce. It is what I call tactical de-escalation. And I think that we are likely to see more tensions happen. The choice of it's a one-year truce is really important because that takes you to the midterm elections in the US.
Yeah.
Because if there's one thing that both parties agree on in the US is that China is a threat to American dominance.
Yeah. I think, as you say, that's a sort of fairly widespread view. In terms of the detail, can we be confident that, for example, all those incredibly important manufacturers in every space between sort of mobile phones and motor cars to pretty much every aspect of technology will now have secure access to those vital minerals, those rare earths that China effectively controls?
No, we cannot. We've gone from confrontation to tolerance. So both sides are going to tolerate each other, but it would not take much for us to step back into confrontation space. The critical aspect for both sides, including the companies, both Chinese and American, is how do you take advantage of this truce to reduce your vulnerability? That is issue number one. You cannot assume that this truce will continue. So you've got a plan for the return of confrontation.
But is there any scenario in which Western businesses can secure alternative sources of these precious materials? Because, if there is, I can't see it.
I think it will take time. I think there are alternative sources. They're not as developed as the Chinese sources are. But you've got to ask yourself the question, are we ever going to get to a first best world where everybody trusts each other? Economists have this tool called game theory, and I don't want to suggest that this is a game because this is really serious. But what game theory forces you to do is forces you to identify the conditions under which the game is played. Trade is inherently a cooperative game. I trust you, you trust me, we trade. If we don't trust each other and we try to turn trade into an uncooperative game, it doesn't solve well. And I think the reality is, certainly between the US and China, is that trust is lacking. So can we get a truce? Yes, we can. But as I said earlier, we're not going to get a peace accord. We're not going to go back to the world that we had some 11 years ago, where both sides believed that they could continue trading the way they were trading before.
I mean, in terms of the classic game in these circumstances, the prisoner's dilemma, this is, I think, what we've just heard, certainly not the worst outcome.
Correct. The worst outcome would have been prohibitive levies or outright restriction on trade. So the US would have had a prohibitive levy of 100% tariff. China would put outright restrictions on export, and both trade would simply stop. In the US, that translates into the so-called empty shelf syndrome. And there's nothing that the Americans worry most about, especially at Christmas time, than empty shelves.
Yeah.
And in the case of China, you would take away a major growth engine. So we're not where we could have ended up, where both sides would have been significantly worse off. But let's not kid ourselves. At least I don't believe that this is going to solve in a very nice cooperative fashion in the next 12 months. I think we will see the return of tensions.
And it does seem to me that, I mean, it just sort of captures how the world has changed since the inauguration of Donald Trump earlier this year. That, you know, tariffs, I mean, depending on which sectors you're looking at, but we're still looking at, well, certainly if you'd asked me, a year ago, what kind of tariffs can the world live with? We've still got tariffs of a very significant sort, and between the two world's most powerful economies.
Yes, and I think economists are embarrassed, to tell you the truth. And you're looking at one who's surprised by where we've ended up. I thought we would slip into a trade war where people would retaliate against the U.S., with the exceptions of China, Brazil, and India. Most countries said, U.S., you can have whatever you want. And that includes Europe and the UK. From a US perspective, if you look at what the objectives were, most economists told you, you cannot achieve multiple objectives with one tool. And yet, whatever we have happened, we have got $300 billion of tariff revenue being raised on an annual basis. So the tariffs are sticking. We have no retaliation, meaningful retaliation. We have more deals being made with the U.S. than we had before. So as far as the Trump administration is concerned, there's been nothing but upside for the weaponization of tariffs. Now, there are longer-term issues that we worry about. Resource misallocations, what sort of culture you create. But in the short term, it seems that the weaponization of tariffs has delivered what the Trump administration was hoping for.
And can I just ask, in your view, if we hadn't had this astonishingly huge investment in artificial intelligence infrastructure, everything from the chips through to new power, would these tariffs have led to a rather more significant slowdown both in the American economy and the global economy? Has Trump, to an extent, been bailed out? Maybe this is just lucky old Trump, as it were, and lucky old world. But has he effectively been bailed out by the AI boom?
So first, you're right to call it astonishing. The numbers are eye-popping in terms of how much is being invested in the enablers of AI, let alone in the science itself. So it is totally eye-popping. The latest estimates show that those investments alone account for about 60% of the growth of the US. So consumption, which typically was the growth engine, is now relegated. And that's why the US has gone from growing at 1 to 1.5%. It's currently growing at 3%, which was unthinkable for an economy as large as the US. So these are astonishing numbers. The question is, are they sustainable? That's the first question. And the second question is there a pot of gold at the end of all this? Is there the productivity improvements that people are investing for? I'm really comfortable on the second one. I think the US will benefit from major productivity improvements. On the first one, is it sustainable? Depends on mitigating the risks. And we haven't seen much risk mitigation so far.
And when you talk about risk mitigation, tell me what you're thinking of.
So there's 4 major risk mitigations. One is to do with bad actors, to make sure we don't repeat the mistake that we did with earlier technical innovations, where we don't have enough standards regulation to limit the probability of bad actors. The second one is diffusion. Unlike China, unlike the United Arab Emirates, all the focus in the US right now is on who's working on AI. But productivity is about who is working with AI. So there isn't much attention being paid to diffusion. The third element, which worries me a lot, is that corporate America, with the exception of a few firms, is more in love with the labor displacement aspect of AI than the labor enhancing aspect of AI. AI has both labor displacement and labor enhancement. The balance depends on how the companies that implement AI think about it. And so far, we've seen just a focus on cost minimization and too much on layoffs, which means we will ultimately lose the support for AI that is so needed. And then the fourth one has to do with what I call the rational bubble. That the financial side of AI has bubble aspects to it. It's rational because the payoff is so big, but it's a bubble because people are investing in anything that has an AI label on it. And there is going to be a small set of winners and quite a few losers in this race.
There certainly are. I mean, there's a lot to unpack there. Before we go through each of those one by one, which I think we should, could I just ask whether you believe that the astonishing surge that we have seen in the stock market since that dip in April, we're seeing companies like Nvidia with a $5 trillion market value. I mean, that is a sum so big, it's very difficult to get your head around what it really means. Basically, all the mainstream Wall Street banks think there is, quite a lot further to go in this bull market. What is your view?
So bull markets tend to have certain attributes that end up in what I call overshooting world, that you will overshoot what is reasonable, and then there will be some sort of corrections. The first one is human, FOMO, the fear of missing out. And what we've seen happen is every single sell-off has been a buying opportunity. So the durations of sell-offs are now very short because people think they're being given an opportunity. And there is this incredible fear of missing out right now, Robert, especially when it comes to something to do with AI.
Yeah.
The second element is that people, when they are in a bull market, they start taking on risk they don't understand. And Jamie Dimon captured it really well when he pointed to a few credit accidents, fraud, and called them cockroaches. Yeah. We are going to see more and more cockroaches.
And this is in that area, this very fast-growing area of what's called private credit. This is essentially lending that takes place out of the traditional banking system.
Correct. All that happens in the so-called shadow banking system.
Yeah. That
can have a way to come back and contaminate what you and I regard as sort of conventional finance. But, there's so much money being thrown at opportunities right now that due diligence in some cases is not being done well enough. And then the third element that is happening right now is that the US is attracting a ton of investment from the rest of the world, from Europe.
Yeah, I know.
And we have this very strange phenomenon whereby people are very excited about corporate US. So the flows into the US stock market from the rest of the world are very high, but they hedge the dollar. They're worried about the mess. As my daughter said, you go long US enterprise and you short the mess. So they're not willing to take the dollar exposure, but they just want the US corporate exposure.
Yeah, which is, I mean, one of the things that has been absolutely fascinating for me over many, many years is how you have this extraordinary powerhouse economy in America and a political system that, to use your daughter's phrase, is just a mess. And it has been for years. I mean, whatever you think of Trump, let's be clear, politics in America has been dysfunctional for a hell of a long time. And yet, as an economy, my God, it is formidable. So let's just say, and the problem with what we used to call irrational exuberance is you're never quite sure when it's going to come to an end. You're never sure when the bubble is going to burst. It will burst. All history proves anybody who believes that this time it will be different will be bankrupt at some point. There will be a bursting of this. Let's call it a bubble. Some of it is definitely showing bubble characteristics. I was talking to some big investors the other day. My sort of analysis, but correct me, please, if I am wrong about this, is that when it bursts, it is likely to feel more like the bursting of the dot-com bubble than the global financial crisis of 2007-8. And what I mean by that is, I think, but do tell me if I'm wrong, the real disaster in 2007-8 is that because banks effectively went bust, the credit creation process globally collapsed, and that led to the mother of all recessions that hurt millions and millions and millions of citizens. One of the things that I still regard as absolutely remarkable about the pricking of the dot-com bubble is actually it didn't lead to a global recession. Central bankers cut interest rates. There was a lot of bailing out in terms of easier credit, and the hit was taken by either a bunch of wealthy people or some investment institutions. But we sort of got through it. As I say, my sense would be it'll be painful if you're too long of Nvidia and Nvidia's share price collapses, but it probably won't bring the global economy to a halt. Do you think that's a reasonable assessment?
I do. I share that assessment. So let me tell you what I shared. First, let's talk about the characteristics of a rally that goes too long. You mentioned the global financial crisis. That really was September 2008. The previous December, the head of a Wall Street bank comes and sees me. And we're talking about where we are. And I said, where are we in the cycle? So he draws an upside down U and says, we are near the top. And I said, oh, so how are you positioned? He said, maximum risk on. And I said to him, if we're near the top, shouldn't you be taking risk off the table? He said, no, for 3 reasons. 1, I don't know what the exact top is. 2, I'm judged on short-term metrics. And finally, everybody else is maximum risk on. Now, of course, that bank had to be saved by the US government 9 months later. But it's less damaging than the internet bubble because there's something at the end of this rainbow, whereas what was at the end of the internet bubble was illusionary. So there is something there, but it certainly, think of it as a race where there's lots and lots of horses. A few will win, the rest will be in the glue factory.
Yeah, let's hope neither you or I are too exposed to the knackered old horses. Anyway, let's go back now to your 4 points. And I was really struck by your point number 2, because this is something that gives me a lot of anxiety about the UK, which is this issue of diffusion. And you made the compelling point that China and indeed the UAE are both massively encouraging their businesses to adopt AI and improve their productivity. Why do you think we are so behind the curve when it comes to taking the measures in terms of adoption of AI that would improve, productivity and growth for the whole economy?
I think there's 3 factors. One is, while the government talks about it, and certainly is committed to growth, we do not have a comprehensive growth strategy. And if we had a comprehensive growth strategy, it would go beyond planning. It would be about innovation and an innovation-driven economy. So that's the first instance, because there are pockets of excellence in the UK around King's Cross in London, the Oxford, Cambridge area. There are incredible areas of excellence, but there is no comprehensive innovation policy that's powering a growth strategy. That's issue number 1. Issue number 2 is one of risk aversion. I often wonder why it is when you offer an American company an 80-20 proposition, 80 is good, 20 is bad, it will tend to embrace the 80 and forget about the 20. Go to Britain or go to the UK, offer an 80 and 20, the obsession was with the 20. And it's really important to realize that it is an 80-20 proposition. You try to unleash the 80 and you risk manage the 20. That's the second issue. And the third issue is funding, private funding. The scaling up that is required right now in this world, the UK capital markets cannot provide it. So when you put all these 3 things together, you don't get the sense that you get in the US, that this is fundamentally transformational. It is what people call a general purpose technology. It's like electricity. It will change fundamentally what we do, and we better figure out what to do with it. China and the UAE have taken that extremely seriously. They have very detailed diffusion policies. The US is allowing the private sector to do it. The UK is neither here nor there right now.
Yeah, it is very depressing. And we talk a lot on this podcast, actually, about the absence of scale-up capital and how much damage that's doing to the UK. I'm also really struck, because we have talked recently again on the podcast, talked a bit about this with an analyst who you may have come across called Azim Azhar. And one of the things we were talking about is the data, particularly out of the States, about the impact of AI on the jobs market. And one of the things that seems very striking is there's been a significant falling off in hiring of younger people, which does look as though it may well be associated with essentially AI enhancing the productivity of older workers and individuals just thinking, well, we don't want these these sort of starter job people. You are going further than that and saying that in terms of the psychology, shall we say, of employers, they are now thinking significantly about replacement rather than AI being used to augment essentially the output of individuals. So tell me why you've got those fears.
So first, let me say there's some notable exception. Walmart is an exception. Accenture is an exception. But in general, if you ask about labor displacement versus labor enhancement involves you retooling, retraining your workers. It involves you understanding that your organizational structure is changing. You're flattening your organizational structure enormously. You have to do a lot of work to unleash the labor enhancement side. The labor displacement side seems really easy. We no longer need entry-level employees to do the things that AI can do really well now. Data collection, doing literature surveys, all this other stuff. So the temptation is to go for the labor displacement. As you point out, you end up in this low hire economy because you're not hiring the young people coming into the labor force. And you and I know, because we saw it in Britain in the 70s and the 80s, when young people are unemployed for a long time, they become unemployable. And that is a real social, political, and economic risk. So that's why I worry about it so much. I think there isn't enough focus on, this is not just about labor displacement. This is about labor enhancement.
Like you, I am deeply anxious about all of this, have been for some time. And I do worry that actually leaders across the world are not thinking enough about the further damage to social cohesion that these sorts of economic and technological developments may well cause. We ought to go to a break in a minute, but there's just one final aspect of this that I'm slightly obsessed with, which is the impact on fairness, equality, distribution of income and wealth, and indeed the sustainability of the tax system. When I talk to those really at the sharp end of not only developing these products, but also analyzing the economic impacts, they do say that it is not unrealistic that in about 5 years, we will have the kind of artificial intelligence that is capable of replacing humans on a very large scale in employment. Now, the ramifications of that are huge. I mean, if you don't have employed people in large numbers, you don't get income tax revenues, for starters. And if I were any Chancellor of Exchequer or Finance Minister anywhere, I would be thinking now about what on earth I do to raise money in a world where my primary source of income, of revenue, are taxes on millions of people. If there are not going to be millions of people employed, where do you get your tax revenue from? Secondly, if you're not going to get millions of people employed, how are they going to live, right? I mean, there's a lot of talk about we need to move towards a system of universal basic income, which is essentially, would be a system where the state expropriates vast amounts of the profits being made from AI and then redistributes it to its citizens in the form of welfare payments. But then what are those people going to be doing I mean, this world of plenty is in some ways amazingly attractive, but I don't think we probably want a world of whatever the level of incomes these people have, just sitting at home aimlessly thinking, what am I going to do with the day? So, these are huge potential issues coming down the track, which are just not being debated anywhere. And is it just that the scale of what could happen is so terrifying that there is no politician out there who simply has the courage to talk about it in public? Why do you think there is no debate about any of this stuff?
First, there's an issue of speed. So let's just think. 3.5 years ago, I first learned of ChatGPT. I had no idea what generative AI was. And along comes something which, as far as I'm concerned, you ask it a question and it answers. 2 years ago, it became about give it a task and it will complete the task and deliver your task. Today, it is your intellectual companion. It's like having 100 PhDs. They're not perfect, but they're a lot better than what we had before, right there, sitting next to you. That is a really rapid evolution. Now, the scenario that you set out is one scenario of many, Robert. Let me take you to the other extreme. Okay, just so that the other extreme is your clinic in Africa that suddenly has access to top doctors. It is your school in a very poor part of the country that suddenly has adaptive teaching going on in a manner that's not possible. So this technology, depending on how we use it and what context we establish for it, can either be equalizing or at the other end, incredibly disruptive.
But isn't it probably going to be both? Because your vision is completely consistent with the scenario that I painted. You could, it seems to me it's very likely that we will have both of those phenomena.
So it's a question of balance. And I said in the beginning it's an 80-20. Some people say it's 20-80. We have an influence on this balance, right? And I agree with you. These issues should be debated. If I were forming a government, I would have in every single meeting a growth czar, someone who forces the question of how did we discuss this? Is it leading to inclusive, sustainable growth or not? And sometimes you have to force yourself to ask that question, because things are changing so quickly that if you don't ask it over and over again, you're going to miss important turns.
Yeah, no, I think that's exactly right. Now, don't go away. We'll be back in just a couple of minutes.
This episode is brought to you by Wealthify. If you've ever thought, I should really do more with my savings, you're not alone. Most of us are busy juggling work and family life, so investing can feel complicated. Thankfully, Wealthify makes it simple. You put your money in, their experts take care of the rest. No picking your own stocks, no jargon, just a managed investment plan you can keep track of 24/7. Open a stocks and shares ISA, personal pension, or a junior ISA for the kids. And with over 100,000 customers and the backing of Aviva, you know your money's in experienced hands. Plus, when you deposit or transfer to a Wealthify stocks and shares ISA, you could earn between £50 and £1,000 cash back. Please note that minimum investments apply and cashback varies by the total amount of your deposit or transfer. So for investing, savings and pensions, the smart money's with Wealthify. Open your account today at wealthify.com. Wealthify is authorised and regulated by the Financial Conduct Authority. Offer registration closes on the 2nd of March 2026. T's and C's apply. With investing, your capital is at risk.
Welcome back to The Rest is Money with me, Robert Best, and I'm delighted that Mohamed El-Erian is still with me. We've got this budget at the end of November the 26th. We know the Chancellor is going to have to put up taxes pretty significantly because she's ruled out significant spending cuts, and she's going to have to find, and I'm not going to go over these reasons again because if listeners to this podcast know why she's got to find about 30 to 40 billion, but she's going to have to find a significant sum of money. Now, the big agony within government is that they're, given that they box themselves in with their manifesto saying, they can't raise VAT, they can't raise income tax, they can't raise corporation tax, and they can't raise national insurance. That's what the manifesto says. What they're agonizing over is whether they should break the manifesto because this is an enormous sum of money, and there are all sorts of reasons why doing lots of little tax changes would be suboptimal. Putting up VAT looks like an absolutely disastrous thing to do because the Bank of England might well see that as inflationary, and it might lead to slower reductions in interest rates were they to do that. So what the Treasury is alighted on is a possible rise in the basic rate of income tax. Each penny just on the basic rate raises about £8 billion, just over £8 billion a year. If they put a penny on all the rates, that would be somewhere over 10 billion. So if you did 2p on all the rates, that would be about £20 billion. If you were the Chancellor, would you, given the narrow range of, well, what you might call pleasant options facing her, would you go for an increase in the basic rate of income tax?
Robert, I said this over a year ago, that the world had changed and that the Labour government will have to look at the manifesto and explain to people that the world has changed, and you cannot rule out the two major levers of budget revenue. So I don't think, as much as I hate saying this, I don't think she has a choice. I think she's going to have to do it. But there's a more fundamental problem. You know, the government came in with the right instinct. It's about growth, growth, growth. And then it got derailed on one fiscal issue after the other. The budget should not be a narrow fiscal event where you try to make numbers add up. It should be an economic event. It should be an economic event that asks the question, how can you use fiscal policy not only for financial stability, but also for economic growth? And I worry that the UK has gotten itself in this corner where it's all about adding, oh yes, we need 30 billion here, we need headroom of 10, no, the headroom should be 20. And it all comes down to adding numbers up without asking what are the economic implications of choices that are being made. And I really worry about that. I go back to what I said earlier. Unless we get high growth, we are going to be talking, you and I will have this discussion in a year's time.
No, you're totally right. And it is profoundly worrying. So let's write this budget, say that she raises 35 billion or whatever it is, and a big chunk of that comes from putting up income tax. What would you encourage her to do alongside that, which would encourage business leaders and investors that the growth path for the UK is being enhanced? Because if she simply takes money out of the economy, most people will say, well, that's a dampener.
Correct. And that's the risk. And if that becomes a dampener, growth stalls even more, tax revenue stalls even more, public services continue to be under pressure, and we end up in this vicious cycle. That is exactly what I worry about.
So how does she get the animal spirits flowing?
Look, I admire this government for its commitment to growth. I would love to see this commitment translated into a vision, translated into what I call intermediate targets. What is it that we are targeting to deliver this growth? Because Britain can and should grow out of its problem, not contract onto its problem. We need a growth vision, and we need, as I said earlier, a growth strategy. It's not enough to do planning, housing. Those are necessary conditions, but they're far from sufficient. What is the innovation policy right now for the UK?
You know, every week I meet amazing entrepreneurs, particularly young entrepreneurs. I mean, some of the talent we've got in the UK is just amazing. How do we harness all that talent better with this innovation policy than we're doing at the moment?
So let me just say, the raw material is all there. I've seen it. I've experienced it. We have a perfect example in DeepMind. Okay, DeepMind was born in the UK by a British citizen, but when it came to scaling up, he had to go to the US for capital, but he made a really important choice. He said, I want to remain in the UK. I don't want to go to Silicon Valley. And as a result of that, it has developed a bit of an ecosystem around DeepMind because people have spun out of DeepMind and created other startups. So if you have leadership, if this thing is enabled, there is incredible talent in the UK right now. Look at what happens in Cambridge. Look at all the startups in Cambridge. The startups in Cambridge are larger than all of Germany. Just to give you a feel, for the scale of this.
But the thing is, even, with some of the businesses that have somehow been connected to DeepMind, they're being financed by US venture capital businesses, not by UK-based ones. And this is deeply troubling.
Correct. But we need a growth strategy. Let's forget about the UK. Let's go to Europe, where their problems are a multiple of the UK's. We have a great report, the Draghi report by Mario Draghi, the former president of the ECB and the former prime minister of Italy. He asked a simple question. Why is it that so much European capital funds US activities? And he went through the lack of competitiveness. He went through the problems in the capital markets. These are all solvable. They just need leadership. And most importantly, you have to sell a growth vision.
Well, but then you've also got to be consistent, because I think one of the reasons why, as you say, there are two, let's go back to the UK for a second. There are two problems. One is too much of this government's growth vision is about inviting the US giants into the UK, which is fine. We do need some of that infrastructure, but you and I agree they should be doing far more to encourage our brilliant young businesses to get bigger. But also they've got to be consistent. To bring us back to the forthcoming budget, it's so contradicted the government's own growth pledge that it put up the costs for employers with the increase in employers' national insurance. It would be, I think, a catastrophe if any part of this budget is perceived by employers, by business, to put up their costs significantly, which is why, in the end, I'm afraid the burden is going to have to fall on, all of us in the broadest possible way. Do you think that's right?
Yeah, look at the sequence. You're absolutely right. So you rule out income taxes, you rule out VAT, and then you're left with national insurance, and then you put it all on the employer side. That was round one a year ago. And you overburdened one tool because you had ruled out the other two tools. Now, this tool is overburdened, so you can't go there. So you're going to go do a 180, go to a tool that you had ruled out. That's why over a year ago, I said, look, the world has really changed, and these promises will not be held if the objective is the well-being of the country. So I'm worried about this flip-flopping from tax on companies to tax on individuals. These things have to be solved in a comprehensive fashion. But most importantly, I can't stress this enough. They have to be solved not simply as a narrow fiscal event, but as an economic event that promotes economic growth and productivity.
Yeah, no, I'm sure you're absolutely right about that. And just finally, because we're almost out of time, annoyingly, but you have spent quite a lot of your career understanding debt markets, bond markets, why conditions for governments that are raising money change. The effective interest rate for this government has fallen a bit, but nonetheless, it is paying significantly more to borrow than many other big nations, comparable nations. And it's got a lot of debt coming up for refinancing over the next couple of years. It's not just the amount it's going to have to borrow in new money. It's also the refinancing of its existing debt. Obviously, she feels, and I have a lot of sympathy with this, that, she has to persuade the investment community that she's not going to be reckless in terms of increasing the quantum of debt, the burden of debt on the UK economy. But do you think that creditors to the UK, investors, would respond positively to a more compelling growth strategy? Would that in and of itself also encourage it? Rationally speaking, if people think the economy is going to be growing faster, then the credit of the government should improve, and that should lead you to the sort of virtuous cycle of interest rates coming down for the government. But how confident of that would you be?
Very confident. Look, there's only 4 solutions to excessive debt. 1 is you grow out of it. 2 is you financial engineer your way out of it. Markets don't like that because they're distorted. 3 is you're going to massive austerity time and time again. Markets hate that because they know the austerity won't hold. And 4th is the default. So if you look at the 4 ways to get out of debt, markets understand that growth is by far superior. And she's right to worry about the bond markets, because what's interesting is not the absolute level of the yields, because that's a global effect. It's the UK versus Germany, UK versus US. And that gap is too large. And not only that, when something goes wrong in the US, the UK reacts by more than what US yields do. So she's right to pay attention to the market. However, she has to understand that the sustainable solution is not just abiding by the fiscal rules, but is abiding by the fiscal rules in a growth context. And that qualifier is really important. And I know I sound like a broken record, but that is the reality of the situation right now.
Listen, you're not a broken record. You cannot say these things too often. So, as always, I'm grateful that you've been on the show. I thought it was a compelling conversation as ever. I'm hoping the Chancellor is listening. She's still got a few weeks to sort the budget out along the lines that we've discussed. Mohamed, great to see you. And I'm going to invite you on now after the budget so that we can assess whether she's properly heard what you had to say. That's it for this edition of The Rest is Money. Thank you so much. See you soon.